Hello. Welcome back, everyone, to Alpha Beta Soup. I'm TXMC. Well, today we'll talk about a few different data points. We'll look at Bitcoin and the stock market as usual. We'll also talk about the options market. We'll look at the VIX. We have an update on US housing that I think is very important. So we've got a few different things, a potpourri of topics today. So stick with me. We'll bounce around a little bit and we'll try to keep this video brisk. If you enjoy my content, make sure to give this video a thumbs up and subscribe to my channel. I appreciate all of your support and I couldn't imagine doing anything else. Now let's get into it. So we've got a green day in the stock market so far in the early going. The open was just half an hour ago by time of recording, but we also have a severely red day in the crypto market. Bitcoin is down 2.5%, while most of the equities, at least in the early going, are up 1% and change. But we'll see how the day plays out. What's been going on a lot lately is that the morning move tends to be reversed by the afternoon. So maybe we get a pump and then by lunchtime things are fading again. But from Bitcoin's perspective, there are a couple of data points that I thought worthy of mentioning today. While price hasn't really developed much and there aren't any real nuggets of discovery to unfold here today, there are some things that we should talk about that I didn't mention in last video that might be good to keep top of mind, or at least have as part of our framework of what to expect. And the first of those things is really right here with the perpetual futures basis. So if you've been watching my channel for any length of time, you've probably heard me talk about this metric, and what it's representing is the price difference between the spot market where you buy physical Bitcoin and the futures market where traders bet on price movements. Those two markets have their own prices, though they follow each other very closely. And depending on what's going on in the market, the spot market or the futures market can get out ahead of the other one. When we've talked about this indicator in the past, we've looked at times in the past where there was a positive value on this perp basis. And what that means when you see these red bars, when a value is above zero, what it's showing you is that the perpetual market has a higher price than the spot market. That can happen either because there's a heavy bid in the perpetual market and it's pushing price in a faster way than what's going on in spot, or the physical market is seeing a sell-off that's more aggressive than futures and causing its price to go below that of futures. So it's a pendulum that swings back and forth. There's recently been a huge premium that emerged. You can see it right over here. And it's the first time we really got that since November. We talked about this a couple of different times on the channel. And if you saw me go on Blockchain Backers channel about a month ago, we talked about this indicator. There was a really strong trend for multiple months of futures being behind spot, which in a way was signifying the shorting behavior going on in futures, the kind of hedging that was going on there, and a lack of any kind of long bias, any kind of sustained bullishness. Well, we've now finally seen that discount revert to being a premium, and by historical measures, it's a significant one. I do think that contextually, this is not the same kind of signal as what we witnessed back here. So in both of these instances, we got a premium while we were in an uptrend, and it was showing that there were futures traders who were going long and helping to push price in a bull market, right? They were getting behind the price action, they were taking out leverage, and those long positions created a premium where that market was out ahead of the spot market. But what we've seen over here, this premium really developed in the day of the Luna collapse. So as Luna was selling off, there was a heavy downward pressure in the physical Bitcoin markets, in the spot markets, and they sold off more heavily than futures. So what happens? Since futures didn't sell off as much as the spot market, and we're talking by, cents or dollars, it's not a huge disparity. Alas, spot sold off more heavily, created a premium, and it hasn't recovered. You can see that visualized down here. What this orange line is showing is the difference between Coinbase price and the price on the Binance USDT perpetual future. That's the tether-based Bitcoin future. And you can see right here, when the premium emerged, this is the Bitcoin price on Coinbase falling below futures because of the sell-off, because the sell-off was led by spot. And since the pressure was less strong in futures, their price wasn't as negative negatively affected. And so this premium emerged, and you can see it's trying to recover. It's been trying to recover since March 10th, March 11th, and it will get there soon. Before long, this premium will collapse and it will probably become a discount again. But I wanted to point this out because this metric is used by others, not my actual script, but the perpetual basis is something a lot of people look at. And when you see this premium, one might think, well, we've got some bullish action. Look at the last time it happened. But when you think about the context of the sell-off and the fact that it was really driven by physical Bitcoin being sold, partially because Luna was selling Bitcoin, but also others were joining in. That pressure created this premium. So this is not really bullishness. There's not really a sign of leveraged longs in any kind of majority in the futures market that would be explaining this in some other way. It's because of this move we saw here. So that was worth mentioning. I wanted to point that out. And you know, when I go down to my lower time frames here, this is Bitcoin on a 2-hour chart. It's really just chopping around in a very condensed range. Now I drew a little high, mid, low Fibonacci on here based on the range. And you can see all we do is oscillate. And that's what this price action loves to do, is just oscillate in a range. When you zoom out to big time frames, that's all it does, right? It finds a big range and it just chops around in it. So we're in a big range, in a smaller range, and now we've got this micro range. Price doesn't move in one direction for a long time, even though you might argue that this is one direction. But we're seeing this morning now, we've got a wick down here. It did break below this level, though it got bid back up. It looks like it came all the way down to 28,000 on the nose. We hadn't seen that price since May 12th. Maybe it scared a few people here, but we did get some buy pressure. Sometimes when you get these little liquidity grabs, they can provide some fuel for price to move back up. And since we mentioned that equities are seeing a green day so far, possibly this will help fuel a little bit of intraday upside, but I don't really know. And intraday Bitcoin price movements are not the focus of my channel. And when I look at options for Bitcoin, which isn't a massive part of the market, it's not driving price all the time, but it has been growing. And in the last few months, usage of options has really been on the rise, both in crypto and in traditional markets, as participants hedge themselves against what looks like obvious downside. So we've got a lot of players in the market that are hedged right now. This chart here is showing you Bitcoin options. Up at the top, these bubbles get bigger when there's more open interest in options. They get smaller when there's less. You can see over here, there's a big cluster of these bubbles now. This in the middle is the open interest in options. So these bubbles are visualizing the growth of these bars. And when you look up here, you can see it's pretty much at the highs. There was one period of time where we had more open interest, and that was in March, a couple of weeks before we reached the all-time high, when we were doing our little Bart Simpson rollover. So we've had open interest. It's been climbing really fast over the last few weeks. It grew a lot during the Luna debacle, and it's risen some more in the last week or two. When we look at the line down at the bottom, this is showing the put-call ratio. So the line itself is the put-call ratio of the open interest that you're seeing up here, the standing orders. The color of the line, blue to red, shows the put-call ratio of the volume itself. So the options that are being exercised, the trades that are being closed, those are part of the volume, whereas open interest is a snapshot of open positions. Put-call ratio was declining in the second half of the bull, but it's been rising. It rose during the first part of the year when we were really scared about the war in Ukraine, what was going on over there, and people were starting to understand the trouble the market was in. It declined a little bit. We started to bounce off of the lows. Equities were also bouncing off the lows in this time, and we saw a little bit decline in put-call volume. But here recently, puts in volume rising. You can see that by the line changing from blue to pink to dark red. Also, the line is going up. So the put-call ratio of open interest is also rising. So generally, more puts are being transacted now than in the past. And the put-call ratio of open interest is the highest it's been since July of last year. Granted, back then, open interest was much smaller. Here was open interest back then. It was less than 140,000 Bitcoin. It's now more than 240,000 Bitcoin. It's grown a lot. It's like 40% bigger than it was last year. Granted, there are just the same amount of people feeling bearish, feeling like protecting themselves from downside, maybe even more so now. So there's a lot of hedging going on. There's a lot of downside protection, a lot of insurance being sought. And you know, we can even see this in equities to a degree. when we look at the VVIX. So the VIX down here at the bottom is what everyone is really familiar with. The VIX represents implied volatility in S&P 500 options. So when you see the VIX going up really high, it's expressing that traders in the options market are expecting volatility. They're expecting a broad price move. And as a result, implied volatility is spiking. But when we see the VIX declining and the range of the VIX day to day narrows and compresses, it's a sign that there's less expectation of volatility, less expectation of big price moves. Well, the VVIX up here at the top is the volatility of the VIX itself. It's like the dispersion of the VIX. It's the expectation that the VIX will make a big move. Well, VVIX is all the way down here. It's essentially at the lowest value that we've really seen since before COVID. And this is pretty interesting to me. I'm not an expert in the options market. I'm sure that some of my viewers have a more nuanced and rich perspective of this than I do. And I would love to hear from you if you do. Please leave your comments if you've got something to say. But when I see the VVIX being this low, it says to me, A, there are a lot of people hedged in this market. And it's part of the reason I believe that the sell-off in equities has been relatively orderly, because we've got a lot of people who are wise to the move. They've protected themselves, they've hedged their positions, and we're not seeing that kind of volatility swoosh downwards that we often get in a period of market panic. This has been a very calm and composed sell-off for multiple months. And during that time, the VIX has remained relatively calm. It hasn't gotten above a high of 39, which it saw in January. And that's a pretty low value for the VIX when you consider what this year has been like so far, and that equities are 15 to 20% off the highs, give or take. Usually, those kind of moves are accompanied by spikes in volatility in the VIX, which represents traders protecting themselves and having a demand for higher skew options to protect themselves from a big move. Well, we're seeing a suppression of the volatility of the VIX itself. So if the VIX is not moving a whole lot, that says to me that volatility is really in a panini press here. It's being compressed hard, and that usually tends to lead to a big volatility event. You know, you can't suppress volatility in a market. It must be expressed in some way. You know, the risk of taking on exposure to these assets must be expressed in some format. You can't take that out of the market. And oftentimes when you see the VIX get compressed, when the VVIX is compressed to super low levels, oftentimes it's accompanied by a quick move higher. Now, I don't know if that's what we're going to get here. I don't know. It's just something that's been rattling around in my mind here. I don't know the makeup of S&P options. I haven't looked at the options chain. I'm purely looking here at the VIX. I'm seeing the VIX being relatively compressed in a very small range. It hasn't really created highs. My dotted line here is at 40, and we haven't gotten above this level since back here in November of 2020. So the VIX is very compressed. The expectation of large volatility moves is very compressed, and historically that often leads to quite the opposite happening. I don't know. This has just been on my mind the last couple of days. I wanted to put it out here on my video, and in part I'm hoping that some of you can maybe talk me through what you think this means, because like you, I am a learner, right? I come on here, I look at a lot of data points, I try to understand the market, and I express my views to you. Sometimes I get those things right, many times I get them wrong, but this is my process of learning. You're watching me understand the markets in real time. So this is an interesting dynamic here. I really wasn't expecting to see this all the way down here, considering we're at the lows. Right, so these vertical lines here are the other times when the VVIX was this low. And down here at the bottom, which I'll magnify for you, is the S&P 500, right? And you know, here in the middle, we've got the VIX, obviously. I just noticed that these other moments where the volatility of the VIX itself were very low were kind of in uptrends, right? Like look at all of these. They're when the market is not at the low, but has been recovering or is at least still in a trend. But we've got that over here, like at market lows, when just a couple of days ago, the S&P hit official bear market territory for a few minutes. This doesn't add up to me. And I think that the market is positioning itself for a painful volatility explosion at some point in the next couple of months. I don't know what will trigger it, but you can't keep vol suppressed like this when we're all the way down here at the lows. It's just very atypical. So we'll see how that plays out. Your guess is as good as mine. We did get an update to some of the econ numbers we were looking for this week, and one of them was new home sales, which we do need to talk about. New home sales on a month-on-month basis fell 16.6% in the United States. That is a big number. The last time it fell that much was July of 2013. And as a result of the fall of new home sales, the monthly supply of homes down here at the bottom, which is based on the sales rate, skyrocketed to 9 months. It's been hovering below 6 months for many years now, and we suddenly jumped up to 9 months of housing supply. So there is a sudden slowdown in the demand of new home sales. And when we take this data and we look at home construction, it appears that there are some disinflationary forces piling up behind the curtain in the housing market. It's already well known that 30-year fixed-rate mortgages have skyrocketed in the last few months, and they're now at decade highs. That's not good for the housing market. People who are buying a new home now are paying considerably more for it than they would have if they bought a year ago. And a lot of that has to do with the interest rate jumping from 2 3/4 to 5 1/4. Huge jump in 30-year fixed-rate mortgages. Well, we've got a couple of other things piling up. So we did mention the slowdown in home sales. If you look up here at the top, this is the total sum of new home sales monthly. This value fell down to 2020 levels. Look, this is the whole housing bubble from 2020 and 2021. The sales numbers have finally come all the way back down after this 16% fall in a single month. Over here, we're looking at housing unit construction. So up at the top, I've got 2 lines. The red line are housing units completed. The blue line are housing units started. The construction has begun. It's important to point out that housing units on this top chart can be apartment homes. They don't have to be single family homes. But when we talk about new home sales, these are single family homes. So there's quite a bit of overlap, but some of these metrics are not a one-to-one. Still, when we look at the disparity between homes completed and homes started, the delta between these two values is the largest it's been since 1984. Down here in these orange bars, this is the delta. This is the difference between homes completed and homes started. Homes completed and started delta has fallen all the way down here, and it's, like I said, the biggest delta we've seen since 1984. This black line is the supply of homes. It's the same line that we see represented down here on this bar graph. It's here in line format. And if you look at the way this line moves, and you look at the way the home completed versus started delta moves, they tend to move together, right? The supply of homes tends to align with how many of them were recently completed, right? It's supply coming onto the market. You can see when there's a big delta of homes completed, the supply of homes begins to rise until we reach a point where the market is oversupplied and that trend reverses. The supply of homes comes down as the delta between those completed and those started closes. And you can see it oscillates over time. It's been very consistent until recently. Now what we've got over here, we've got a bunch of homes that were started that are not yet completed, while we also now suddenly find ourselves, based on slowing down sales rates, having an excess of supply of homes. So because fewer people are buying them than were a couple of months ago, the sales rate has fallen. Thus, the count of the month of supply has risen. At the same time, a lot of new homes are currently under construction and are likely to be completed sometime this year. That is a massive inventory about to hit the housing market at a time when they are already seeing declining sales. I believe that this will be a very disinflationary force on the housing market. Mortgage rates are going to do what mortgage rates do, and the rate of sale of those homes appear to be declining as we are entering a period where inventories will be rising. So demand falling, inventory rising, that should be a disinflationary combo for housing. And honestly, it's what the housing market needs. Real estate investors, people who sell homes, homeowners, you may not want these values to come down. You may not want a slowdown, but the economy needs it. Millennial first-time home buyers need it. And many people are watching for this to play out. So the housing market does appear to be reaching a point where things are starting to slow. And just on a personal note, I recently closed the sale of my late parents' home. They both passed away in the last few years, and we sold their house just last week. And I feel like I sold the top of the market. I don't know if that's true, but just when I see all this data, we see mortgage applications coming down, which I don't have to show you today. I'll try to get that data point for next time. But mortgage applications are slowing down. We've got sales sales falling off. We got supply based on sales rate increasing, and we've got a ton of homes under construction that will be completed at some point. A massive dearth, creating a divergence here. This is a disinflationary divergence by my estimation. So I am keen to keep my eye on that. Now, I won't talk too much about monetary policy or anything in this video because we've spent quite a bit on it the last couple of videos, and there's not a lot new to discuss. So Powell gave some remarks earlier this week, but as you can see here from Walter Bloomberg, he made no mention of the path of policy in those remarks, and that was going to be something I talked about. So we'll just put that aside and we'll wait till next time. Maybe there'll be a little more to unpack. So I know we covered a lot of bases today. I jumped around to various data points, and I didn't have an overarching theme to the whole video like I do in many cases. Part of that is because, well, price isn't really doing anything, but also because this is a very complex market, and sometimes we need to just let things play out and not get too ahead of ourselves and get too cute trying to predict. So I'm very much in a wait and see mood right now. We talked about the housing market. We talked about disinflationary forces piling up behind the curtain over there. We talked about how in the options market, there does appear to be a lot of hedging, a lot of protection for the downside being sought. And when we look at equities and we look at the VIX and the VVIX, it's showing a suppression of volatility, which aligns with all of the hedging we see in Bitcoin. And I don't know, to me, it sets up for a big volatility event if we actually get some kind of a catalyst that starts moving these markets outside of their little choppy ranges. Something that I'll be keeping my eye on. Make sure you follow me here on Twitter at TXMC Trades. I post a lot of thoughts and charts on here, and I try to respond to people whenever they reply to my threads, so we get a lot of engagement. If you have questions for me or feedback for this channel, if you disagree with my analysis or feel that I missed something, please leave it in the comments below. I'd love to hear about it. As of now, I'm planning to do a live stream on Monday. I'll tweet about it before I go live, and I'll mention something on YouTube over the weekend so people can know to keep ready for it. But as of now, that's my plan. I think Monday morning is a good time. I don't want to do it over the weekend. I'll let you guys have your days off. But Monday morning, let's pencil in a live stream. You guys and me, we'll look at some charts. We'll do some more on-chain because I know I get asked about that. And we'll just kind of take it where it goes. So take some time for yourselves this weekend. Find a way to relax, and we'll reconvene in a few days and see what's been shaken out. Until next time, you know the drill. Take care of yourselves, friends. Be kind to each other. Make some time for your families. If you have kids, tell them you love them. And you and I will chat again in just a few days. So until then, cheers, everyone.